There's little doubt that this week's market conditions have been quite tough to trade. We've seen a lot of stop loss hunts. We've seen markets showing us bearish probabilities and then instantly rejecting those ahead of earnings season. But that's the big thing we need to discuss today. The biggest banks out there in the US are about to report. And as we know, since the Silicon Valley Bank crisis, things have not been so good for those stocks. Will they show doom or gloom, or will they show some optimism for the US? Markets are clearly at critical. We also want to be talking about Federal Reserve liquidity. I've got some custom charts for that and discussing central banks' interventions in this market recently and whether they're actually tightening or they're loosening overall. Well, welcome back everyone to the Daily Show where we talk about markets around the world, including the macro, the news, and all of the lead indicators. We've also got the hottest charts coming up. And if it's your first time here, welcome to the community. Consider subscribing and smash that like button if you find value in today's video. I'm sure you will. So let's begin with what happened over the last 24 hours. There's little doubt that I actually thought we would get rallies into continuation sells. Now, one of the reasons was the close at the low. We saw selling pressure at the end of the day. But then the PPI came out and it showed that we continue to see price pressures and inflation, because it's a lead indicator, really showing us that maybe things are getting better in the markets. But it's not really about inflation in 2023 like it was in 2022. It's about Q1 and Q2 earnings. And both of those, or at least Q1, is about to come up. So what does this mean leading into the big banks? Well, we'll talk about the banks soon, but let's discuss sentiment surveys, because often I use these as a contrarian indicator. If everyone's super bullish, then we consider whether there's bearish technical analysis that is being shown. If it shows you a clear bearish signal and everyone else is bullish, well, of course, you should be a bear at those points. But look at this chart, 39.5% of people are neutral. In fact, not only are bank managers and investment managers neutral, now retail traders have become neutralized. Nobody seems to have any real opinion on this market. Makes it very difficult to trade, of course. 35% basically are still bearish, 39.5% neutral, and the bull side dropped. So this was taken as of the 12th of April, and it was a question asked what's going to happen over the next 6 months in markets. And we tend to really use that very heavily along with our other analysis, and it's been very good to us all the way since 2021 to realistically now. So let's talk about smart money versus dumb money inflows. Again, this is just showing a similar kind of trend. Markets are at these highs. We're seeing dumb money kind of pouring in still, purchasing up, and smart money selling those rips. If we do end up breaching and we get above levels such as 4180, which we'll talk about later in today's video, then that probably means that we're going towards something like a 4300 plus. And if we do see that and we continue to see this kind of go up and this go down, that kind of divergence or movement away usually shows us that we need to be incredibly careful. And those are the points where, options and other instruments can be incredibly beneficial. Let's talk, though, about something else, which has to do with the Fed and central bank injections. Now, I promised you I'd update the chart if I saw a change. Remember, this tends to take about 2 weeks to come through. Sometimes it's faster. Usually it's a bit slower. And what it is it's the difference between basically the amount of stability in the markets from the central banks around the world. Now, it's my own custom indicator, so don't ask me exactly what it is, but basically it is taking into account many different things, including, of course, the tapering. Now, if we think about Silicon Valley Bank and Credit Suisse crisis injections, you'll see this huge injection into the markets. If you also look at the last kind of maybe 6 months in the markets, you can see why we've traded a lot around 4,000 with both injections and declines coming through, almost like it was manipulated to sit in that level, which the central banks quite like. Now, declining central bank support, that's what we've had recently. And I'll continue to update this through the next couple of sessions, especially into next week, because if this continues to decline and markets do go up, I found that that is not a thing that you want to be looking at. You need to fade those rallies in general terms. We know that this market is often run by these central bankers. And even if we come down and we consider the total assets here, you'll see the tapering started again and started to come back down, which could have pressure on semiconductors, on technology, and a lot of the stocks that many of you out there like. Follow along on Twitter as well. Links in the description down below if you're interested. I will be updating that chart quite a lot. Now, I won't go too much macro today because I want to focus on the charts, but I will just quickly talk about equity risk premium. A lot of people have got this. I've read some of the comments down below. A lot of people have got this confused. It is not an instantaneous thing. It is a multi-month, 6-month, 9-month kind of concept. Basically, if you're an investor, you care about equity risk premium. If you're a trader, maybe you don't as much. And what this shows you really is that it's just not at the greatest time ever to be investing in stocks based on previous history and based on this particular concept of equity risk premium. We know it increases into recessions. The Fed literally has told us we're going to expect a mild recession. Now, I probably believe that means it's a little bit worse than mild because I've never heard a central bank claim there's going to be a mild recession. But anyway, that's something that is there and that's open for discussion. We also know that we're entering that 1.7 range, which gives us usually an annualized poorer return. So if we have an annualized poorer return when we're below these numbers, then it's not really a time to have extreme FOMO. Remember, trade when you believe you have edge and you have that opportunity. I really want a lot of members in the community to reduce the FOMO. You got to reduce the FOMO and you will have so much better time in the markets. Don't listen to other people saying, oh, I made $1 bazillion. That just makes you feel bad. And that doesn't actually lead to better trades. If you have a story, please put it in the comments down below to help members in this community. Maybe read some of those. I will feature some of them on our weekend video, especially if there's some good stories that help other people learn what not to do. I've seen it all. And I can tell you that most people make huge mistakes when they feel FOMO or fear and they end up doing something they shouldn't have done and they regret it for a very long time and it leads into a kind of self-spiral bad kind of time, yeah? So we don't want to be doing that. Let's talk about ERP. So we see this usually going up during recessionary periods. We're pretty sure that a recession will happen, but remember, it's not going to be called until inversion goes away. So we're going to need to see bonds inversion going away, and that we're not anywhere near that at this stage. I'll leave this chart just up here as well, which is yield curve inversion, and it predicts usually the recession length. The Fed said it's basically 2 years long. Usually we kind of go with how long have we been inverted. So far we've been inverted 13. I'd expect at least 15 to even 17 kind of months here. So we're probably going into some kind of recession length that's over here in this side. Now that's just a general chart, but it's something very interesting to look at. So let's talk about earnings. We know that these banks are coming out. Wells Fargo, JP Morgan, it's going to be a big one. And when we get these volatilities, I mean, I'm not used to seeing such high volatility on banks. I mean, we're talking about 7% implied vol for Wells Fargo, about 5% implied vol for JP Morgan. So no wonder the markets are back at these highs. Although I didn't expect it to rally back up into that resistance, I thought we'd take the low first and then we'd be talking about that today. Well, it makes sense. I mean, if we're going to break out, these banks are going to report better. What are most people going to be looking at? I don't think it's really the earnings themselves. It's probably the forward guidance and what's going on in terms of consumer behavior that people will be reading into. So if you're interested in following it, you got to check out those results. We obviously don't have the crystal ball exactly on how banks are going to report and how the market's going to, react to that. But overall, usually banks remain usually optimistic into it, which we've seen on the price action when we look at financials a little bit later. And then the reality kind of bites. Is the reality better or worse than expected? Now we'll find out very, very soon. Consumer discretionary, communications, technology, they were the best sectors over the last 24 hours. Utilities, one that we've been following, and healthcare, kind of more flat, up a little bit, not too much. If we go over the last 5 days, we've now seen a bit of a switch here. You can see industrials, financials actually showing the two best. And this makes sense. I mean, we're going into earnings season and we're seeing a little bit of optimism as people buy into that kind of dip scenario, looking for potential value in financial stocks. We'll look at those very, very soon. So just before we jump into the charts and we take a look at all of the key levels that you need to be watching right now in the markets, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, the platform itself has quite a few things you're going to be needing this earnings season. With the big banks about to report and also big tech about to come out as well, you're going to need to be on top of many things, including sector rotation. What might surprise you is over the last 10 days, semiconductors have actually underperformed the overall market. Did you know that? Well, these are some of the things that you can get by checking out concepts, US market overviews, and all of the things that are inside the platform itself. But more importantly, you'll also need to be on top of the earnings season itself. Report announcements, the latest news refreshing every literal 1 minute, along with premium feeds from Reuters and other things, daily, weekly, monthly calendar selections, and even the ability to customize them to your watch list or even positions you own. It's great to know when things are coming out, and you can do all of that within the Tiger Brokers platform. To make factors even better, at the moment we have a special offer where there's an additional $30 worth of Tesla fractional shares on top of everything else for members of the FX Evolution community from Australia. And there's a whole bunch of other special offers down below. All you need to do is fund with as little as 1 cent, all the terms and conditions, and you'll get not only access to a great trading platform, but a whole bunch of special offers. So what are you waiting for? Check them out. This offer ends on the 15th of April for the Australian viewers out there. So you need to get in and funded before that date. So check it out now. So let's jump into the charts. Let's begin here with one we haven't brought up in a little while, which is the VIX. So the VIX is 17.81. It's historically getting on those low ends. Now we've got this super low over here, which is January 2022. I've still got alert set for that, which is 1637. I also think it's interesting. We just went under Feb 23 and both of the lows there. So you can see here on the weekly and on the daily that the VIX is very low leading into this earnings season. So fear is almost gone. And when you see fear almost gone, that's a time, especially at resistance, that you can be cautious. You can be waiting for the next kind of zone. And we'll talk about that when we load up the S&P. There are some levels that I would also check, 17.09. I think both of these, we just hit one alert for me, which is taking those lows there. And all of this is kind of where I get cautious, especially with the amount of potential negativity that could still come into this market. If we go over to the US 10-year, you can see 3.322 is still a level that we're looking to breach below to show us that really yields are that the economy maybe is very weak and it's going to need Fed support. And at this stage, we just haven't really seen too many movements in yields, and maybe earnings will do this. But if we take a look at December, there's still a lot of expectation by the market that the Federal Reserve is going to cut. I don't think they will. But that's my opinion. I just don't think that historically they were able to. Remember, when they pivot, they don't tend to pivot and then instantly cut. They usually pivot and hold and then cut when they're dealing with inflation. So I think they might hold it a little bit longer than the market expects, and possibly that could cause like a fit later on. Now, on the positive side for bulls, little positive here is copper. I mean, copper's breaching back up. I guess, look, I lost a position in this. Obviously, I had shorts and I've been removing a lot of shorts over time. I don't usually trade copper. What I instead do is I trade other pairs that tend to go poorly off that. And it did very, very well for me. But I was, historically short over here. Copper has been weakening. I don't exactly like what it's done. That's not really ideal. Once we got through this level here, well, we'll still look at copper. Obviously, we'll use it as a sentiment tool, but it doesn't exactly look weak unless this instantly rejects over the last 24 hours. So this week, because we need that weekly back down to really hold in those levels. Otherwise, maybe it's breaching to the upside and there's further optimism in these markets. So we'll continue to watch copper, but this is it doesn't seem too correct to the current markets unless we really are in a super recovery. And I suspect that we'll just keep following it and we'll keep looking at what it's showing us. Let's move over to the US dollar. So it actually took a new low. So you can see here it got a new low. And the US dollar continues to get bombarded by so many different things. Yields dropping, BRICS, what else do you want? Like conversion of different currencies, like instead of the US dollar for contracts. There's a lot of firepower going against this. Now, this weekly closing down here will be very significant. Not only will rallies continue to be met by sell demand, but I actually believe that we might be going underneath parity. So even though this is a very heavy sell, I do think that we should see a reaction around here pretty much over the next 24 hours into this news. If we don't see that, so you can see it's gone the low, I'm going to put a little alert there above this high. Basically, we're looking for this type of switch, and then maybe this could be a swing failure point kind of position. But if it does hold underneath on the weekly and keep moving through, I think there could be more pain to come for the US dollar still, even though it is very extended. And this just comes down to looking at currencies. You look at the pound US dollar, you look at the euro US dollar. A lot of those have been quite bullish, and especially the pound has broken through some key resistances. So gold. Now, I made a report on this over the last 24 hours that the stats are starting to look a little nasty for gold. Now, that's, of course, a macro or data stat. We've still got lots of bullish action going on, but no new yield lows. So generally, I like gold going up when yields are going down. I won't explain it now because it takes too long, but that's something that I do like to see. It's a great breach out, and I think it's going to trap a lot of people into longs. And I'm interested to see the weekly. Remember, we've never closed a weekly anywhere near in these highs. We've always seen these big rejection wicks. The data points towards gold and silver actually having a rougher time here. I know that the storyline and everything seems really good. And don't get me wrong, I'm holding gold long term, long term. But when I'm talking about short term, everything looks pretty good still for the bullishness. I'm not going short yet, but I am looking for the signs. And what that means is that I'm cautious, very, very cautious here. I love this entry. If you got that, congratulations. We talked about the bullishness there. We got that rejection off here. Then we snapped that over the last 24 hours. Dollar fell through. Gold's moving bullish. I just think that the macro or the data is starting to look a little bit negative. I wouldn't be surprised at all, though, for gold to do something it always likes to do, which is a giant blow off, where you get these huge gains similar to these ones. And then markets go boom, boom, boom. And then they stabilize and go back up. That's the type of thing I'm looking for in gold. I'll report back when we get more information. Nothing yet. Natural gas, struggling still. Watch out for your stop losses if you are in this one. There could still be hits on these. I still like the fact that I think it's basing here. So even though it's come down, I still feel like it is basing at this stage. And natural gas is, of course, you're trying to stop a bit of a freight train. Now, we do want the weekly to close bullish. So I'd like to see the next 24 hours finding some bulls, because you can see here these candles are not looking great. One's already closed badly. This one here had a rally and then a sell. So we really want natural gas to hold this week. If it doesn't, otherwise we're going back into this structure. 180, not so good for natural gas players. But we're cautious on this, but still optimistic around those levels. Let's move over to oil. Oil has come back a little bit. Now, I've put a interesting scalp zone in here at 80.587. If markets do sell off, I feel like there could be some buyers around here. And there's quite a few reasons why that's possible. But let's just say that within these kind of box here, between 80 and 80.587 or 80.60 really, I'm liking the idea that buyers can recommit there, at least for a scalp, different from a swing. I'm not swinging this thing up at the moment. I'm not actually that bullish on oil anymore based on yields, demand destruction, all sorts of things. So it's just more of a trade. But I do think that there's a key level there for some potential, and of course, practice your own risk management. Let's move over to Tesla. What's going on here? Pretty lackluster. It was up 3%. I know that seems good, but really Tesla's been, question mark, not that great. We've seen buying down here in this structure. We saw a beautiful hit earlier in the week. Then we saw a sell-off. We're not at a critical high, nor are we at the critical low. So ahead of the news, ahead of the banks, basically Tesla's doing not much. I still like that idea that it goes to eventually to 145, but that's going to need the market to turn to the negative side. And if we go and scroll into the 1 hour charts and the 15-minute charts, you're not going to see much that you like either way. It's just a lot of kind of gaps down, gaps up, gaps down, all sorts of action in here. It's just really the critical zone down here, which is where buyers are. And I still think sellers sit somewhere around that 196. So if we see a big rally, potentially sellers are at 196 in this case. Let's move over to Apple. Now, this could be, is that a sign that markets really want to go bullish? That's an island reversal. I mean, little wonder. It's gap below, gap up. That's what it is. So on the surface, that looks pretty good. I mean, it's back into the resistance trend line. This thing has stopped Apple every time during every rally. So this big chart here, this has stopped it all. And look where we are ahead of these big banks earnings, and of course coming into, some tech next week and stuff like that. So absolutely critical for Apple. There's no doubt. That actually looks pretty bullish. Great day. Pullbacks may be met by bull demand. That's the way Apple looks. Of course, just an island reversal, but still in the direction of trend. Usually I don't fight those too much. We have had quite a few of them throughout this run that have done quite well. So yeah, I mean, on the surface of it, Apple looks quite good and ready to break. However, we haven't got major markets through yet. Let's look at semiconductors, still looking quite weak overall. Nothing good coming out of semis yet. We're still not through those highs. We could be in distribution or accumulation. We don't know yet. And again, was this the sign of actual sell-offs? I'm still kind of leaning towards the sell side here. We haven't shown the strength yet across markets, but maybe the bank earnings will push us through either way. And then you've just got to basically think of it as, well, if you're ever going to take shorts from that point on, you've got to really consider options instead and long dating them so that you can protect yourself from what could be a bit of a brutal rally. Let's move over to financials. So financials took a low a little while ago. They've rallied up here. They're not really at what I would call an extreme resistance or not. Let's have a look at regional banks, because of course that's what came under the most fire. Now they are just sitting at their lows. So the volumes dropped off considerably. The market is not optimistic on these at all. And into earnings season, we're not really seeing a huge amount of buyers. Now these are at close to, really big buy zones for a lot of, I think, people. I'm not really buying them. I like that when you have such a huge sell-off, especially 20% plus, you've got to wait quite a while for a base to form, and that's where that patience comes in. Generally, a horror sell-off like this can take weeks, if not months, to actually fix itself through. And that's not the tech way. The tech way is usually it comes back pretty fast, but that's usually what happens with the older banks or the older companies in the markets. RSP, speaking of different markets, we've got S&P 500 equal weight. Look where it is, right in the golden pocket ahead of the big bank news. We've got the DAX. Now, that's actually a breakout. Weekly will be pretty interesting close here. We get a long leg doji in the previous week. We've got 1 day left of trade. I'm probably just going to say wait for the weekly to close on that one. There's no real point. XJO, the Australian market, again, we're going to have to wait for the weekly to close to tell us that maybe pullbacks will be met by buy demand. I don't think there's that much edge here. If I was in the buy side, I couldn't be scared because we haven't got to change a trend. And it's kind of like that for a few of the markets. Let's have a look here at IWM. Where are we? Close to that 181, 180 zone. So 180 on IWM. And if we look at the US 2000 futures, you can see here it's that 1810. So this was a pretty nasty one because that's a nice shooting star coming off exactly where you think sellers will come. Then you expect rallies to be met by sell demand. Look, it's a statistical thing. If I saw that enough times and I took the same thing, which would be rally into sell, into that like kind of 1740, you're generally going to be very, very correct. I mean, I believe 70% of the time, that's the way this is setting, the way it was, the way it sold into the close is correct. I think PPI may have affected it, and that led us to go a bit more optimistic that markets were going to be ahead of the bank news. See, what I actually suspected would happen is this, and we'd end here or something like that. Kind of like a downward trend line. That's not what occurred. You can see here the Qs actually made slightly higher high. We're not through the critical resistance. You can see the watch reaction here zone. Very important to breach that. But if you breach it, what is people going to do? Well, they're going to say, well, this is a flag. This is a length. They're going to take that length of the pole. So let's say that whole length of the pole, and they're going to extrapolate that out, and they're going to pull these numbers and look where the numbers go to. It's a pretty good proof. So the market's setting up for certainly a potential of bullish action, even though we're at a bearish point. I see a lot of people freaking out like, oh, the market's running and it's amazing how markets are so good at doing this. Guys, we're literally under where we were only a few weeks ago. 31st of March, we literally have done nothing. So people are freaking out like this market's run without them and gone up 20 million %. I understand it's higher than where it was, but I'm very surprised how fast. Well, I'm never actually surprised. I've seen it before, but yeah, I sometimes I wonder. Like people get freaked out about missing out on things. Remember, as a trade investors, sure you can freak out. You need to have your kind of set and forget style purchase opportunities. But when you're talking about from a trade side, I don't think there's too much to be freaked out of. You're just looking for the next opportunity. Let's look at the financials. The US 100 futures. So the US 100 futures, this is still where we've seen resistance. To have a close into this, though, not ideal. You want to see more that type of thing. Wicks often hold orders, and that was a great hit. I mean, I love that. I really did love that. Like the way that the previous session played out, I'm telling you, it was a very solid short opportunity that generally comes along. So to reverse that, especially on the SPY, which is where we've got the short opportunity, was quite surprising. I truly think it's more of a news relation. We've still got the watch levels up there. We now have a new gap that we could fill. We have so many gaps left down below by markets. Let's have a look at the SPY here. Obviously, expected weekly options high 416. If we go here to the SPX futures, and if I curve fit this, there you go. That's where you're going to have. So that's wick to wick. So technically, yes, that is the right thing. The markets have come up and actually filled a gap as well. So this was a gap that was left from the previous markets. The real market, not just the futures market, filled that. So actually, we filled the gaps, and this little T gap up here that I've got is actually minuscule. So it's really not that much to write home about. So we actually filled this. If we look at something like the Dow as well, so we look over to the Dow and we go to the monthly, which we'll do now together, what you might notice is that the monthly is also sitting on a fairly critical kind of level. It's gone and tapped into these previous kind of closure zones. So I do think that which is so critical. I know you hate that word, but yeah, it's everything in here has been the same, really. It's always been the same kind of level. So let's look underneath the hood. We're back up here. We filled the gap, so we can now remove that. So we can go to the 2-hour chart. And I've got here quite a lot of things that I've had set up for a while, so we can remove that. We can add a new gap because, of course, we've got another one. So this now means that we have 1, 2, 3, and 4. Wow, that's quite a lot. I don't really remember having 4 for a while that are so close together. So this market's kind of been a bit more rampant. We are back here, and actually, if you notice, that went a little bit of a higher high. So I think, there's a lot of still opportunity for sellers to come through. Let's have a look at on the surface. What levels could we reach over the next 24 hours? Well, can you see 4180? Can you see these highs? 4180, of course, a daily close like this. No, well, drop's going to be met by buy demand. I mean, that's the way the market's pricing. But if we get kind of like this and then we go, oh, wow, like you've got to believe at that point you had a fake out, and then you sold, and then you have another fake out. Yeah, things would definitely start to look like a Wyckoff, a distribution, and things would be probably more bad, which is good if you were a bear. This is why options are better, though, in these types of market conditions, because the problem is there's so many little hunts and sneaky things going on in these markets. So what was my expectation? Well, we closed on the lows in the previous session, kind of like this. So we closed on the low. I expected a rally. I thought maybe anywhere in here is possible. And then I thought we'd sell off again. Now, the setup was beautiful. I mean, this setup here, which, by the way, you would have never lost on because you would have been breaking even on that in the small time frames, was absolutely great. It's a great setup. Very replicatable. Patience, react, don't predict. It was absolutely perfect. So the idea would be to fill that. So go back to the 40-60. And what I kind of suspected was we'd do this. Maybe like that. Or we'd come up, down, and then go on that big rally after taking these stop losses. So we didn't do that. And that's what's got me kind of thinking, well, wait a second, are we actually doing something like this? Now, it's all theoretical. You've got to play chess with these markets. And again, I have patience to react to the news because you usually get the setup actually after the news. You don't have to be like this person that YOLOs into the markets and before news guessing the way it's going to go. That's not really the best thing. It's better to wait for the daily closes or to have systems in place that you can take advantage of key levels. So I'd say watch the 4180 zone. I'd say definitely watch the reaction around here and the way it sets up. And if it does something like this, then you're probably looking at more of a sell-off and this being actually a distribution. And I'm actually very excited for the markets right now because I think that so many people are neutralized and confused that we should be able to see a great opportunity moving forward. Let's go to the refresh on the options market. There is almost nothing going through here this week. So we've only got 768,000 units. We know 412 and 420 are kind of the call levels. And we know that technically maximum pain is 407. So I guess that favors the downside. However, it is not a main week, so we don't really use it too much. A lot of people freaking out now about Bitcoin. Of course, my profit target was 30,200 once we breached through. I remain with that. Now I'm absolutely looking at the storyline. I'm actually extremely excited for this level as well. I think that these markets and the zones that we're at are just such a great zone. Like, so much that can happen here, so much opportunity for a proper swing. And although the market is continuing to rally up, I'm not suggesting you sell it yet, by the way. Remember, we didn't believe that was a sell level because of what we saw here. So at this stage, it's kind of just going up. We've breached through, next 24 hours. I'm really looking for signs, though, at this point. I do think the bears will recommence in here. You could always be wrong. But again, if you're wrong, have you pulled the trigger? How are you going to pull the trigger? I like this red box area for structural creation. And that's why I've had it there for 3 months or whatever it's been. So yeah, certainly looking at that. Now, it doesn't just stop at a little bit. We actually still have core retail sales. Then we have earnings from the banks. Then we have prelim UOM consumer sentiment. And if we scroll through to the next week, we can see that we start getting Empire State Manufacturing Index, and we get a bunch of information coming out from other places around the world. And then, of course, we get some big European news along with flash manufacturing PMI. So next week's really more about earnings. That's where I think the markets are really leading and tending into. And of course, we'll be doing, as we always do, beats and misses. I'll be updating on Twitter, and I'll be updating, of course, here on YouTube. So if you're interested, consider subscribing and smash that like button as well if you found today's video helpful. This is a very neutralized market. I really stress that you've got to be cautious. Obviously, the optimism and the current trend is still bullish. So you really cannot go against that theoretically without proper risk management. I just wanted to stress that. If you haven't already followed us, do so. Twitter, Discord, our website, if you're interested in anything we do. If you're interested in the type of way of scalping these markets, check out the Advanced Scalping Masterclass. And of course, you can get free trading cheat sheets as well. Do also remember that today's sponsor of the video is Tiger Brokers, and there's only a few days left to take advantage of the special Tesla Additional. Now, that's only for members of this community, so all you have to do is focus on the 1 cent or greater funding, and you'll be able to get that kind of $80 worth of fractional shares. You will need to be from Australia and possibly New Zealand, I think. Links in the description down below, though, for the T's and C's. Thanks so much, guys. Have a great day. And I'm super excited for the next week. I think there's just some beautiful levels focusing on here. I know it's confusing. Don't get me wrong. That last 24 hours, there was some weird action. But yeah, I think it's the PPI. And I'm not really going to look too much into it until we actually see a breach of either side. Bye for now.